Welcome to another edition of the Savant Investor. Please support us by subscribing. The US is in a recession, but the stock market marched higher. The S&P 500 dropped 34% from its high in mid-February to its bottom on March 23rd, the quickest decline of its kind in history. Yet, stock rebounded with vigor despite bleak economic news and protests that have spread across the US. The U.S. officially entered a recession in February per the National Bureau of Economic Research. It's the country's first since the Great Recession a decade ago, and its severity has drawn comparisons to the Great Depression, the country's worst economic downturn in the industrial era. Nearly 43 million Americans have since filed for unemployment benefits, shattering prior records. The country's 14.7% official unemployment rate in April was its highest level since the Great Depression, when it peaked above 25%. The rate rebounded to 13.3% in May after the economy added 2.5 million jobs during the month. Why is there a disconnect? The divergence makes sense for several reasons, according to market experts. Namely, the stock market is not the economy. Stock investors are looking beyond present conditions toward what they believe will happen in the future. One is looking at today, the other is saying where it's going, today versus tomorrow. The market is saying, we know where we are today, but where are we going tomorrow? In this case, tomorrow is 2021, which they're currently viewing with optimism. Investor sentiment has been buoyed by state reopenings that have begun across the country and the expectation of a vaccine which would help normalize the national economy as social distancing measures end. That could point to a rebound in consumer spending, the linchpin of the U.S. economy, and retail sales. The widespread protests currently dominating the news cycle are unlikely to have a big effect on the stock market unless investors see a risk of long-term economic damage.
I would say the economic data is old news for the market purpose. Right now, most market participants are looking beyond the second quarter to try to understand the second half of 2020 and beyond. Meanwhile, a survey of financial advisors suggests they're taking a rosy view over the long term. A quarter of advisors expect to increase their stock recommendation to clients over the next year, according to a joint survey published last week by the Financial Planning Association. Strange, amid some of the market's largest companies, the so-called FANG stock, F-A-A-N-G, represented by Facebook, Amazon, Apple, Netflix, and Alphabet, which is Google's parent company, also have helped to offset weakness in other sectors like energy.